A very warm welcome to each one of you on this webinar on super trading. Especially, we'll be discussing the indicators that work in the market and how to apply them into your day-to-day trading strategy. Now, simply put, it is a very vast topic, but what we have tried to do it is summarize it, sort of filter it in such a simple way that you can apply it, understand it, apply it, and then eventually, hopefully be profitable as well. Some of these indicators that we have been using on a day-to-day basis, something which is like a staple diet to, all the technical analysts. I'm sure many of you would be using these indicators, but what I shall try to do is bring to you a perspective which might be different from the way you've seen these indicators work. So, without wasting any time, I'll quickly jump on to my presentation for today's session, and I hope you have a very, very enriching time. Perfect. So, very warm welcome to each one of you once again. Today we are bringing to you the super trading indicators. We'll keep the today's session in English as much as possible so that people across the country can understand this. And what we've tried to do is bring to you the two most indicators which are very, very, very applicable in the market. But before we begin, a simple question to ask, what are indicators? We have indicators everywhere. If you go on the street, we have the signal which indicates which side of the traffic should flow. If we go into the lift, there is an indicator which shows whether the lift is going up or the lift is going down, or whether it be your phone which notifies you and indicates you that there might be a notification or a message. So indicators are essentially alerts which are given from time to time based on the changes that happen in any given situation. When it comes to markets, there are essentially two types of indicators, leading and lagging. Leading indicators are the ones which give you an advanced signal, and lagging indicators are the one which give you a post-event confirmation, or rather they are slightly behind the curve. Now, because we have a bullish side in the market and we have a bearish side in the market, so indicator may either be bullish or they may be bearish. So indicators are essentially alerts, in simple words, which guide you in your trading process, in your investment process. Now, why or which type of indicators are we considering in today's session? So we are considering specifically momentum indicators. So, just to bring you, throw some light on what exactly is momentum. This is on the left, you have the fastest human on this planet. On the right, you have the fastest animal on this planet. Both of them are very fast in their own category. But when they race together, it is undoubtedly the cheetah that wins. So, in simple words, momentum is nothing but the speed at which the underlying is moving. It could be a human, it could be a cheetah, it could be a stock. In day-to-day, when we see charts, when we see news, when we see price information, it is very easy to identify the direction, whether stock is going from point A to point B, very easy to identify. What is difficult to identify is the speed at which that stock is moving from one point to another. This is exactly what momentum indicators do. Momentum indicators give you a wider perspective on the rate at which the stock is moving into a particular direction. So, say, let us assume you're throwing a ball, this is an example of physics which I've taken today. And say, you're throwing the ball up in the air. So the velocity of the ball is maximum when the ball is hurled up in the sky. When it reaches its point of maximum height, that is when the velocity becomes zero or the speed becomes reduced. And then because of gravity side. So this gravity again increases the speed, and eventually the ball reaches from the kid on the left to the kid on the right. Now, this might sound a bit, technical. This might sound a bit, textbook kind. Let us take a simpler example. So, what happens when momentum changes? Taking it a step further. So, you can see this beautiful mountain. It's a nice winding road that takes you from the valley right to the top of this mountain. So on the right hand side, you can see a very beautiful waterfall as well. So say, let us assume you're driving the car on this road. This is the Trollstigen highway, in the Scandinavian countries, where supposed to be one of the most beautiful rides that you can have, drives that you can have. I've just taken it as an example to show what exactly is momentum in this context. So let us say your car is going at 80 kilometers per hour in a straight road, and then you see the mountain, you slow down, and then what happens is you start taking these ghats. So it can be an S curve, it can be a winding turn. What happens before you take the winding turn? You reduce the speed of the vehicle. So let us say you're going at 80 kilometers per hour. If you see that there is a sharp turn which is about to approach, you will reduce the speed of the vehicle. So your vehicle speed may go from 80 kilometers per hour to, let us say, 40 kilometers per hour. So your speed gets reduced. Then you take the turn, which is safely navigate the curve. And once the curve is navigated, you increase your speed once again until the next curve comes. This is exactly what happens in stocks. Say they are going from point A to point B. In between, you have these curves, you have these S bends, you have these ghats, and at every turn or before every turn, the speed of the stock reduces. And what happens when the speed of the stock reduces? There is a short-term direction that happens, change in direction that happens. And when that change in direction happens, it could be a trading opportunity, it could be an exit opportunity, or simply put, it could be something which is giving you an advantage with a particular stock. Eventually, the stock may go from point A to point B, which is where the direction the stock is. But in between, you will have these moves up and down, which is captured through momentum indicators. Now, I hope this makes sense, especially because a lot of us drive cars, and if we attack the bend at 80 kilometers per hour, what will happen? The car will crash. There will be an accident, and intended to do. So in case you do not see these bends ahead in advance, you do not slow down the speed of the vehicle, your portfolio, your trades can also meet with an accident, and you may have a loss. So this is what is exactly a momentum indicator tries to tell you. So what are the top indicators that we follow and that we are going to discuss today? So the first one is a 41-year-old indicator, relative strength index. Mr. Wilder had invented this, or rather figured this out, this method of identifying momentum through the use of prices. Now, how this is calculated, you can simply be resourceful, go on Google and find out the formula. We will not get into the formula because it is not important. What is rather important is how to read them, interpret them, and apply them to your trading strategies. The second one that we are going to discuss today is money flow index, or MFI. Now, some of you would be very fresh to technical analysis. So for the simplicity of everybody, I'll try to plot a couple of these indicators on charts and show you how it can be done without any sophisticated software or tool. So simply put, just go onto the website of TradingView. This is where we have, anybody can access this from your phone, from your tablet, from your PC. Just go to, let's say this is the Nifty chart. So once the Nifty chart is loaded, we go to indicators. We look for RSI, select, and this is how the RSI can. This is the Nifty RSI. This is the 5-minute chart. I'll just move it to the daily chart. Yeah, so the current Nifty RSI reading is 72.16. So today's close for the Nifty is 24,300 odd, and the RSI has closed just a shade above 70 mark. Now, let us plot the another indicator, which is MFI. So we go to money flow index, and similarly we plot the money flow index as well. So very similar to the RSI. There's a slight difference we will discuss in the coming slides, but this is how you can plot the Nifty graph along with the RSI and the MFI. It's very simple to do, very simple to see it visually. And once you understand this language of interpreting these charts, a lot of these trading decisions can be made easy. Now coming back to our presentation. Okay, so this is how we plotted the indicator. So RSI in simple words is, there are two ends to this spectrum. It is an oscillator, which means it can either be 0 or it can be 100. It will be between these figures. So anytime it goes above 70, it is considered overbought, and every time it goes below 30, it is considered oversold. Now this 70 and 30 was, discovered 40 years back, not necessarily relevant today. But what is relevant is every stock has a different overbought zone and every stock has a different oversold zone. So for a few stocks, 70 may not be overbought, 90 may be, and for a few stocks, 30 may not be oversold, but 10 or 15 may be. So, horses for courses. So different stocks have different overbought, oversold zones, but generally speaking, anything above 70 is overbought and anything below 30 is considered to be oversold. So this is as simple as it gets. If you see a stock which is above 70 RSI, okay, it's a time to book profits. If you see a stock which is below 30, it is a time to probably buy the stock. Now, this is a very simplistic view of what RSI is. There are, another levels to it. So, it could be a positive divergence or it could be a positive convergence. Now, what is divergence and convergence? Now, divergence, as the name suggests, which means anytime the price and RSI move in opposite direction. So like as you can see on the left hand side, the price is moving down, the indicator is moving up. This is a positive divergence, which means the speed of the vehicle is increasing, which means there is a possibility that the stock may reverse. On the other side, if you see on the right hand side, it's a convergence, meaning the price is going up, so is the RSI. So divergence and convergence are essentially the two different moods that the RSI indicator or the stock exhibits. Let us make it simpler and see a few examples. So as you can see in this graph, this is a sample which I've taken from the internet, but it is very much, this happens in day-to-day markets. Now this is an example of eBay. Every time the stock RSI went below 30, it was oversold, and these were buying opportunities. As you can see in the graph, there were 3 buying opportunities, and once the RSI went above 70, which was a good selling opportunity, and after that the stock saw a correction. So a very simplistic view. You can simply trade based on visuals. Let us take one step ahead and discuss something, which we have shared in the very recent report. So we released the Kalki 2024 report, and there was a list of 26 stocks which were very overbought. So these 26 stocks, if you simply see the monthly charts of these stocks, the monthly RSI of these stocks is very much overheated in the vicinity of like 85, 90 and 90 and above. So if you can see, like the first stock that I take here is ABB. The current monthly RSI is 91, which is the June ending RSI, and the all-time monthly RSI, all-time high monthly RSI is 93.7, and this happened way back in April 2006. So on almost like a 20-year time frame, the stock is extremely overbought. So whenever we see such windows, such overbought situations, we take a call and say, okay, this is a good time to be booking profits. This is a good time to take your money off the table and probably wait for a correction for re-entry. This does not mean that this is the end of the bull market, but what this means is, 10-year, 5-year, 15-year. I mean, since this is a very big horizon, what it means is over long periods of time, the stock have delivered the best performance, and when everybody is greedy, this is a good time to be booking profits. So this is one of the examples that we've taken where we've actually shortlisted stocks based on their monthly RSIs. Now you will have a question, Rahul, what is monthly RSI? So if you plot a monthly chart, you will get a monthly RSI figure. If you plot a weekly chart, you will get a weekly RSI figure, and basically the different timeline will have a different RSI number. Now this RSI number essentially is basically telling you that out of the time free period that you've selected, so a stock could be overbought in a monthly RSI, but it may be oversold on a daily RSI as well. So even these type of variances are very much normal. Don't be surprised by them. We'll take you one step ahead and one step further and tell you how to distinguish between the same. Now coming to the second indicator, which is very much similar to how RSI is read. But the only difference in MFI or the money flow index is RSI only takes price movements in its calculation, whereas MFI takes price plus volume in its calculations. So essentially it tells you whether the money flow is positive in a stock or the money flow is negative. So as you can see in this graph, there are multiple trading opportunities that were had every time the money. So in money flow terms, in MFI terms, to anything below 20 is considered oversold. Anything above 80 is considered overbought. But these are textbook numbers. Don't go by them. Different stock will have different overbought or oversold areas. And if you see the historical data, you will get more and more confirmation. Okay, this is 75 is, say, for example, overbought for an X stock, whereas 95 million overbought for a Y stock. So it's different for different stocks. But the idea here is we are trying to identify whether the stock, there are two ways to do it. One is whether the stock is overbought, oversold, or if there is a divergence building up. So as you can see in the first instance, the stock made a new high, but the MFI didn't. So it was a bearish divergence. Whereas in the second case, the stock made a new low, but there was no new low registered on the MFI, which is a bullish divergence. And after that, the stock did an extremely good move from 28 odd to 34 in this case. So this is how, the reading of the MFI also goes. It's just the calculation which is different for this index, for this indicator, but eventually the outcome that it is trying to tell us is very much similar to what the RSI is telling us. Now let's see how Nifty is placed. This is the Sun Pharma stock that we've recommended today. So today there was a bullish breakout on the MFI. So if you can see on the right hand side, we plotted the MFI indicator. So MFI indicator actually broke the trend line on this, and this trend line breakout happened in today's session. This is exactly the reason why we had a buy recommendation on Sun Pharma. And if you can see, the RSI is also shaping up. Now you may have a question that there are two colors on the RSI. It is nothing but the moving average. The red one is the moving average, which is just trying to smoothen the line. But moving averages may not be required in this case. Simply have a look at both the green lines. So RSI is shaping up, MFI is breaking out, and as we saw today's session, the stock closed very firmly today above the 1550 mark, and also there is a spike in the daily cash volume that we've witnessed. So this is an example of a breakout based on the technical indicator that we've witnessed, and both RSI and both MFI has given a positive signal in this stock, and we expect the stock to do well. Now if you bought this stock, once the stock starts moving up, as with risk management, keep on trailing your stop losses. But this is how you can read an indicator and apply it, and eventually have your trading strategy devised around it. Speaking of trading strategy, let us see how the Nifty behaves when we track the RSI over a long period of time. So this is the daily chart of the Nifty for past I think 18 months or so. So in the Nifty, what is happening is every time the Nifty RSI has gone close to 80, it has been overbought for the Nifty, and Nifty has seen topping out formations. So for example, the first time this happened was when Nifty was probably close to the 18,000. I don't know the exact number. We'll get back. We will see that in the charting software. But every time the RSI has gone above the 75-80 mark, this is where exactly reversals have happened. In this case, it was not a sizable correction. Nifty kept on going higher. But on the flip side, every time the RSI went close to 30, this has been very brilliant buying opportunities in the Nifty 8 out of 10 times. So this is something which has worked very well. So market can stay overbought for a long period of time. Markets can stay oversold for over an elongated period of time. But these are very credible indicators, especially when it comes to long-term plotting, long-term charts plotting, and at the same time, it is very reliable when it comes to taking those slightly medium-term decisions rather than day-to-day trades. Slightly where you have a one month view on the stock or the index. There's something that can be very, very beneficial. Now another example, again an RSI diverging from price. This is where the stock hit a new high, but the RSI did not improve. The RSI health was deteriorating, and post that there was a correction that was seen. So this is one example. Now you may have a doubt that what if there is a divergence, or what if there is a signal, but how do we take action on it? So in this case, as you can see, the RSI topped out way before. So where we've crossed, that is not the area that you sell. Just because a stock becomes overbought is not the reason for you to sell. After it gives a breakdown, especially on the price confirmation side, that is when the bearish signal activates and you can take a sell recommendation, sell call in the same. So in this case, what has happened is after the stock became overbought, after the RSI crossed 70 mark, the stock spent some time at higher levels. So it was overbought for some time, and then the market realized that okay, the stock is out of the steam, and then finally we saw a breakdown happening in the same and the stock going downwards. So this moral of this slide is take action based on the price behavior. We'll come to the rules on the last slide where we discuss what are the do's and don'ts when it comes to trading with RSI, MFI, and how you can fine-tune your strategy based on that. So this is another example of a bearish divergence, the stock making new highs, RSI not improving, and eventually there is a correction that was seen in this particular chart, which is Bitcoin in terms of USD. So this is how essentially you can look to trade using RSI and MFI. There are three ways to do this. The first way is overbought, oversold. Simply look at buying and selling opportunities based on the extreme reading that you can get. Second is if there is a divergence, bullish or bearish, you can take a call based on that. And thirdly, if you have a trend line breakout or a breakdown, as we saw in Sun Pharma, there is a trend line breakout that has happened in today's session, and plus it has closed above that, so more confirmation. These are the examples, three categories of trades that you can take based on these technical indicators. Now coming to the next slide, which is rules. So what are the rules that we advise to follow? So the first rule when it comes to indicators is indicators are always secondary confirmations. Price is always primary. Always await for price confirmation. So in simple words, it is said bhav bhagwan hai, and that is exactly what we mean, that if you see an indicator telling you an X or a Y, buy or a sell in an X or a Y stock, do not act on it unless you get a confirmation on the price. It could be a pattern breakdown, it could be a bearish or a bullish candle. Unless you see that in price and volume, don't take an action just based on indicators alone. Secondly, divergences can be very good lead indicators if coupled with price action. So like we saw in the recent example, if the divergence is coupled with the price action of a breakdown or a breakout, that is where it can be a good lead indicator. So as we speak, Nifty is going higher and higher. Nifty RSI is also going higher and higher. As we saw, Nifty RSI is above 70. It is overbought zone. And in the past, we've seen 75 to 80 is the area where Nifty has seen topping out formations. And a lot of stocks that we've shared, especially where the monthly RSIs are above as high as 90, that is where you can take these polaristic trades and basically be slightly ahead of the curve. Third rule number, convergence is a lagging indicator unless it is coupled with price patterns. So convergence is basically when both price and momentum indicators move together, but these are not leading, these are lagging indicators. So keep that in mind. And lastly, never follow more than one or two indicators, as opposing indications or opposing signals can play spoil sport. What that simply means is I've seen people apply multiple charts. They may have RSI, MFI, ADX, Williams R. There are multiple these indicators running, and what happens is these multiple indicators at times give you false signals or give you opposite signals. Okay, so I go ahead with it. So what the point that we are trying to make is, do not follow more than one or two indicators, because the more indicators that you follow, the more is the possibility of you getting opposite signals or you getting conflicting signals. And when these conflicting signals happen, you will miss out on the trades more often than not. So just stick to one or two indicators and stick to them in your entire trading journey. What happens is, there could be phases where an RSI doesn't work, there could be a phase where MFI doesn't work, but if you do enough number of trades consistently, the law of averages will catch up and you will have a very decent strike rate, success rate when it comes to trading the market. So this is what we had to share with you today on the RSI and MFI indicator front. We can now open the floor for Q&A. and looking forward to answering your questions one by one.
Okay. Thank you, Rahul, for a sharp and insightful session. We shall now begin with the Q&A session to address the questions raised by our audience members. So, question one, could you guide us on how to read open interest change?
Yeah, so open interest is basically the number of contracts that are open at any point in time in a particular future or an option. Now, what happens with open interest is, the textbook way of seeing open interest is yesterday XYZ stock had an increase of 10% open interest day on day. How do we interpret it? So point number one, open interest is a lagging indicator if it is seen at the end of the day. So keep that in mind. While the live market is on, that is exactly when you should be tracking these OI changes. And if the OI change is something which is, say, price is going up, open interest is going up, that is an indication that long build-up is happening. And that is exactly where you will get the maximum bang for your buck. So do not wait for EOD figures to make a call based on open interest. In index, it may work, but in stocks, it seldom works because we've seen stocks move so fast these days. The discounting happens in a matter of few hours, forget, a few days. So because of that, you might be very late in the trade if you see EOD figures. So open interest goes up, price goes up, long built up, the textbook definition. Open interest goes up, price goes down, short built up, textbook definition. And basically you can find these online everywhere. But my reading is, if you can track them on a live basis, on a 15-minute, half an hour, 1 hour basis, you will get more success based on what is happening on the screen rather than doing it and following it a day later. So that is how open interest can be helpful to your trading strategy. So let us assume you are trading Nifty, you are seeing a positive price breakout, you are seeing RSI improving, and you are seeing open interest build up also happening. So you've got 3 confirmations. You can trade long in Nifty, and there is a good chance that that trade becomes profitable. So this is one of the examples where you can use open interest to add on to your conviction, which you already have based on, say, XYZ factors. Open interest can be an additional confirmation to take your trade, or in a relatively bigger way. So you might be trading just 2 lots in Nifty, you might do 10 lots because what has happened is your conviction level has gone up because of the open interest data.
Okay, moving on to question 2. Can you share some feedback for how to choose the right equity shares for short term and long term for purchase?
Yeah, so long term, you can refer to the Kalki 2024 basket that we've released for fresh buying ideas. These are the stocks which we feel can do well. Essentially, when we identify these stocks, we look for major price patterns on the monthly, weekly charts. Or if it is not a price pattern, then we look for if there is any big mega volume buildup that is happening in a particular stock. More often than not, price patterns are something that we rely heavily on, and they have a very decent strike rate success ratio. So when it comes to long-term investing using technicals, it is best to use price patterns and do the underlying volume analysis. So price volume is something that we closely track on. Simply you can Google price patterns, and there are so many patterns that can be studied. The longer the time frame, the more is the reliability of the pattern. That is something that I've personally sort of verified with my trading experience. And the shorter the time frame, the lesser is the probability of that pattern being played. Yeah, next one.
So moving on to question 3, please could you share some hedging ideas to safeguard capital?
Yeah, so hedging is something, watertight hedge does not exist in the first place. So if you are, since I assume this question is regarding, I have a long portfolio, how do I hedge that portfolio? Markets have gone up. So watertight hedge never exists. And for a portfolio, for individual positions, you can do it by using short positions. But the simplistic way of doing hedging, there are 2 ways to do this. One is simply buy Nifty put options of a slightly longer dated period, which acts as a buffer in case Nifty corrects. That is one way to do it, but again, it will not be watertight. The second way to do it is raise cash. So raising cash is the best hedge because you're booking profits and coming out of the same. Sector rotation is second, that can be done alternatively. Like for example, today markets are overheated. we've recommended some sectors which are very overbought. You can book profits in them and look at sectors like IT, pharma, chemicals, where the risk reward is relatively better. So that acts like a natural hedge without creating much of a impact, or rather without missing out on majorly in case there is a big correction. So these are my thoughts. I may be wrong, I may be right, but more often than not, we've seen that raising cash is the best hedging strategy that you can do.
Moving on to question 4, which is a more reliable trading indicator, MA or RSI?
Moving averages. Okay. You have to ask the question, where is moving average derived from? Where is RSI derived from? Both are derivatives of price. So both are essentially being derived from the underlying price movements that are happening. So, derivatives will definitely follow what is happening in the underlying. So when it comes to trading, taking these calls, the moving average might give you, support levels in case, say the stock is trading above its 50-day moving average, the stocks come down. 50-day moving average is supposed to be like a decent support that can act as a support level. Or if the stock is reversing, from a very, very big oversold zone, 200-day moving average can act as a resistance. So when it comes to identifying resistance and support, moving averages are very good. When it comes to identifying overbought, oversold, divergences, so both are actually, very different. Both of them have different applications. The indicators will actually give you a buy or sell signal, whereas the moving averages can also give you buy and sell signals. But we use it more for identification of support. Once the stock takes support around the important moving average and starts turning around, that is generally considered to be a good risk reward opportunity, good trading opportunity. And so both are applied in different instances. And so it's more like you cannot have like a parallel comparison between who is better, but different instances require different approaches when it comes to trading between MA and RSI.
Moving on to the next question, what's the best software for trading platforms?
So you can use any software. I mean, no real software company has anything which is more advanced than the other. Some may have more tools than the others, but at the end of the day, what is important is the indicator, is the interpretation that you use, not the indicator that you use. So everybody in the market is looking at the same data, looking at the same charts, but why do some traders have a very good strike rate, whereas some traders have a very, very average strike rate? The difference is in the interpretation. So you can improve your interpretation game, automatically your trading strategy would improve. So trading software is not that important. Yes, in terms of execution, some platforms may be better than the other, some methods may be different, but when it comes to charting softwares, it's best to stick to something that works for you, and the interpretation is something that is more important.
Moving on to the next question. I always exit at a very small profit and miss most of the rally. Please suggest a proper mechanism to trail stop loss. I am a day trader and mostly follow 15 minutes.
Yeah, so this is one problem which a lot of people face, that I'm booking profits prematurely, so losses are very big, profits are very small. How do we change the whole thing around? So if you can quantify your decision making process, if you can automate I would say, if you can make your decision making process as objective as possible, that will help you overcome this challenge. This is more of a psychological challenge than a mechanical challenge. It's not that you cannot keep trailing stop losses. You can do that, but I think the more you can objectively take your decisions, the better the outcome will be. And at the end of the day, even the best traders don't know which will be their best trade. They take the bets in enough number of in enough stocks, and diversify their trades. And at the end of it, out of 10 trades that they take, 2 of them turn out to be a bumper trades. 4 or 5 of them would be like good trades, and the remaining 3 or 4 trades would be a very very, very difficult negative trade. So essentially, nobody knows what is going to happen in the market when it comes to trading stocks. But if you can diversify it well and simply follow an objective approach, which is unless A happens, I'll not exit unless B happens. So that A B can be a separate discussion, but what I'm trying to make trying to add is keep it as objective as possible and not subjective.
Okay, Rahul, thank you for that. I'll just read out another question. Being a novice to tech analysis, what is the way to start? Any courses or books you can suggest?
See, the best course is doing it practically. Obviously the basics is something that you would like to read up. There are many books, but the quantity of information is so huge that I've seen more many people lose interest or take shortcuts. So the best thing to do is identify, like for example, today we learned RSI, MFI, take them, read about them, apply them in the market for the and see how it has helped you. So I think the best thing to do is take 12 months time frame, keep on learning these skill sets, these things one by one, keep on adding them to your arsenal, and then eventually what happens is after 12 months you have experience, plus you have all the reading that you've done. Then you can once you've become confident on how on building your base for yourself, that is how you can increase your trading quantum, increase your trading size, and until then keep your trading size as small.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.